In this lecture, we'll extend the discussion of balance sheets by illustrating an example of transactions in a startup business. We reiterate the all-important principle of duality in every transaction. It's keeping to this principle of duality that actually gives us a balance sheet. When she contributes that $3,000, it comes in the form of a number of different assets. There they are, 1, 2, 3, 4, 5, 6, 7 different assets. So there's her first balance sheet. It starts off with $3,000 of capital that she has put into the business, and that capital is represented by the list of assets down on the left there. And so her balance sheet is shown in the accounting equation, which looks like this. Assets of $3,000. At this point, no liabilities, and equity of $3,000. Well, the next thing that Susan does is to go to the bank and look for some more finance. So the bank gives her a loan of $1,000. And when banks lend you money, what they typically do is put that money into your bank account so that you can then spend it. So in goes $1,000 into the business bank account. And at the same time, we recognise that the business has to repay that loan to the bank, and so it sits on the balance sheet as a liability. Now notice what's going on here. The accounting equation always must be in balance, and so every transaction has this aspect of duality. A transaction has two parts. Here are the two parts. The cash goes into the bank, that's the asset, and the liability is recognised. It's measurable. We know it's going to have to be repaid in the future, and there it is, the liability is recognised. And so when that transaction gets added into the accounting equation on the bottom there of that diagram, you can see that now there are $4,000 of assets. Equity has not changed, but now we also have a liability. So $4,000 of assets have been funded by $3,000 from Susan in the form of her capital, and $1,000 from the bank in the form of a loan. Susan's first transaction. She's going to purchase fasteners, and to do that she's going to use $600 of the cash which is in her bank account. And so what will happen when she pays for it is that the balance in the bank will go down, minus $600, but what she will get in exchange for that is $600 worth of fasteners, which is an asset. And so there you can see that the total of assets doesn't change. The total doesn't change. The composition within that total does change, of course, but the total remains at $4,000. And the liabilities haven't changed, and the equity hasn't changed. And so let's now look at this balance sheet. It's now extended onto a second page, but it's a balance sheet, and see how it's now building. You can see the list of assets starting, and it always starts with current assets. So the protocol here is that assets are always listed in their order of liquidity. So the most liquid current asset, of course, will be cash. And the next one is fasteners, because Susan expects to use those and sell them. Similarly with materials, and office stationery will just get used up in the ordinary operation of the business. So there are total current assets of $2,000. Now let's look at the second part of her balance sheet. Here you can see that there are some non-current assets, a typewriter, a cutting machine, and a sewing machine, giving total non-current assets of $2,000. These assets will still be here next year and possibly the year after. They will not be turned into cash or used up in the next 12 months. So her total assets are $4,000 in the third column to the right. And if you think back, that's what we saw in that accounting equation, total assets of $4,000. The bank loan, next one down, is $1,000, and that's classified there as a current liability. So if you were in any doubt about the nature of that bank loan, now you know for certain that it has to be repaid within 12 months. And so there is a subtotal for total liabilities of $1,000, and then The next figure out at the far right is net assets, that's total assets minus total liabilities equals net assets, and we know that the net assets is the value of owner's equity. And so there is the representation of that accounting equation spread out in a what neatly classified balance sheet. Classification of the balance sheet means that you show assets in current and non-current, liabilities in current and non-current, and owner's equity, and you show them all separately and all grouped together neatly with appropriate subtotals. Now, I've touched on this when we looked at Susan's transactions, the duality of every transaction. Every transaction has got two parts, and those two parts will offset each other, and they have to do that in order to keep the accounting equation in balance. And that, of course, is why it's referred to as a balance sheet, because it is in balance. And finally, just a couple of balance sheet ratios to start you thinking about how to read the information that's in your balance sheet. Let's start off with liquidity ratios, and there are two that are always used when you're analysing a balance sheet. The first is referred to as the current ratio, and as the name implies, it's the relative position of current assets to current liabilities. When you do the maths for current assets divided by current liabilities, you often, not always, but you often will find that current assets exceed current liabilities, and so the answer will be greater than 1. Now look at the note at the bottom. I hasten to point this out to you, and you must remember it. You need to interpret these liquidity ratios in the context of industry and operating environments. Please don't rely on so-called rules of thumb, because what's an appropriate liquidity outcome for one business may be entirely different and inappropriate for another business. So always interpret your findings here in the context of the industry and the operating environment. So let's go back. The current ratio, total of the current assets divided by total of the current liabilities. A quick ratio, which is a rather more, in fact it sometimes has the name acid test, it is a more acid test of the liquidity position. The numerator excludes two items, inventory and prepayments, and it excludes those because both of them would take a great deal longer to turn into cash if the need became urgent. So current assets excluding those two categories, again divided by total liabilities. And obviously the answer to the quick ratio will be smaller than the answer you derive for the current ratio, but again, please only interpret in the context of the industry and the known operating environment. This ratio starts off our thinking about financial risk ratios, sometimes referred to as solvency. And here what we're probing is the ability to meet long-term obligations. And so we look at long-term figures on the balance sheet. And here we're looking at the two sources of funding, long-term debt and equity, which is longest term or perpetual. Sometimes there are variations on this ratio. Sometimes you'll see using total liabilities. Sometimes you'll see using only long-term liabilities. In the formula that we've got here, we've got the simplest version, which is total liabilities divided by total equity. A debt to equity ratio is something that providers of debt funding will often look at closely. The intuition here is that the more debt you have relative to equity, the more financial risk your business is exposed to. Those of you who have gone through the process of funding and purchasing a home will be familiar with the requirement that banks have to ask you about or to the debt equity ratio. In general, banks won't let you go beyond 80% debt, 20% equity. So that's for private housing. It's obviously different again. Note the point down at the bottom. It's different for different businesses and different industries, and always look at the risk environment which is prevailing in the community.